Apple Inc., ticker symbol AAPL, is currently trading at $224.23 a share. It is currently the second largest company in the S&P 500 with a market cap of 3.3 trillion, only behind Nvidia. So what we're going to be doing today is looking at the stock and then taking it to my automated stock valuation spreadsheet to see if Apple is a buy or a sell using the discounted free cash flow model, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value. So let's just quickly look at the stock. This hasn't been a good year for Apple in terms of their usual return. If we were to compare it to the S&P 500 over the similar time, market is up 26% year to date compared to Apple's 20%. Even over the last year, 35% compared to Apple's 21%. But over the last 5 years, the stock has been on an absolute tear, 237% compared to the market's 91%. So is this the right time to buy, as it looks like Apple is underperforming its usual prices? So if we go to my automated stock valuation spreadsheet and put in the ticker AAPL, what this will do is it'll load all the latest company financial data and we can have a deeper look. So as I said, price $224 a share, a 3.389 trillion market cap, P of 36.86, market average currently 30.6, so it is a little bit higher, but not too much. Earnings per share, $6.08 a share, a beta of 1.24, meaning it is more volatile than the market, and analysts are saying it is currently a buy with a target price of $240 a share. Now, Apple do pay a dividend, 0.44%, meaning you'll get paid slightly less than $1.99 a share for every year you own Apple. If you want to get paid your quarterly dividend, buy the shares before the 8th of February 2025 and you will get paid that dividend. Now it is very safe. They pay around $15 billion, and in terms of a payout ratio, that's about 16% of the net income, and free cash flow payout ratio, obviously of the free cash flow, is about 21%. So let's have a look at the numbers. Revenue, we do have the full year 2024, so we'll not be looking at the trailing 12 months, but currently $391 billion in revenue, not all-time highs. That was 2022's number, but only down slightly. You can see that they have been steadily growing consistently over the last, well, this is from 2010. It has been growing, had some slight ups and downs, had a big jump up in 21, but they are still increasing their revenue, which is what we like to see. Net income, similar story. They had a big jump up in 21 and currently they're at about 93, just shy of $94 billion in profit. Now, yes, this is down from the last 3 years, but overall trending in the right direction. Free cash flow ratio, this is slightly different. They only have 70 billion, I say only, 70 billion in free cash flow. They had 111, that was all-time highs, 99, 108, dropped down substantially here. So if we have a look at the operating cash flow, which is the blue line, CapEx, which is the red, and that gives you the free cash flow in the green. So you can see operating cash flow is still growing, yes, but free cash flow is down because of CapEx spending. Shares outstanding. Apple have a pretty consistent buyback program, as you can see here. Now, yes, there has been some stock splits, so this chart doesn't look exactly correct, but you can see that they basically had very aggressive buybacks since about 2013, and they are continuing to do so, rewarding shareholders that way. So let's go into the discounted free cash flow model. This is a way of valuing stocks, looking at the future free cash flows and discounting them to today's value. So we do have a problem. For some reason, it hasn't calculated the weighted average cost of capital correctly, but Apple is currently around about 8.8%. Oh, check out my Patreon if you're interested. So what we'll do is we'll just manually put this number in here, and then this will give us the value based on discounted free cash flow model. So currently puts it about $130 a share, which will mean the price will be cut in half. Let's have a look and see if we agree with those numbers. So revenue growth rate, we're expecting about 6.4%, which is 416 and 443 billion. Let's compare that to what analysts are saying. Pretty close, actually, 414, 447. So I think those revenue estimates are pretty good. Also, next 5 years per annum, 14.2%. But I'm pretty happy with our estimates on there. We'll bump it up to 7%. That brings it to $134 a share. Net income margins, once again, I'm pretty happy with this number. I suppose 2021 was a bit more out of the ordinary in its number, but I think I'm pretty happy with this. Next is the free cash flow rate. Now 24, and we'll take an average of these two numbers, which puts us at about 109%. That puts it about $147 a share. So not a buy according to the discounted free cash flow model, but the fact that this is, relatively close, obviously 20% discount. They have not been $170 since May of 24. So not too crazy of a price. It's interesting when, yes, it does say it's a bit overvalued at the minute, but the fact that this is in the ballpark shows how much of a free cash flow generator Apple is. Before we continue, please check out my Patreon. I've tweaked the tiers. Have a look. Automated stock valuation sheet is $5 a month. I have an extra one for $7, and just to help me out for $1.50 if you want to help me out, or not, up to you. I won't force you. Dividend discount model. You can see that we've got a bit of a problem here. We'll take an average of the last few years. WACC is, well, as we said, it was wrong. We do about 8.8%. Puts it at $45 a share. So really, they would have to keep on growing their. Sorry, it was 8.8, wasn't it? Yep, 8.8. It's not liking it, realistically. $45 a share based on the current expected growth rate, which is about 5%. So not liking that at all. But we'll quickly jump past that, and we will go to the Ben Graham formula for intrinsic value. This is a way of valuing stocks, looking at the earnings per share, P of a non-growth company, AAA bond, corporate bond, and the current bond yield is 4.95%, very high inflationary once again. And I believe we saw that the 5 years previously was at about 14.2%. So not a buy, but according to Ben Graham, he would not buy Apple. $122 a share, so way undervalued, or overvalued, sorry. But finally, we will look at the comparable company model. And this is a way of valuing companies, looking at similar companies of similar sizes, metrics, industries, and what we're looking at is revenue growth rate, EBITDA, net income, profit margins, price to sales, price to book, PEG, Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and forward PE. Now, I normally end them, but it seems on my last video I was comparing Google and Microsoft, so we already have those numbers in. What we'll do is we'll initially go with Meta, but I do have a different one that I want to look at. We'll look at the top 4 companies of the S&P 500, which is, I did have that up, but I've unfortunately lost it, which will be, Nvidia, basically. Well, Meta are the 6th, only 1.4 trillion. But enterprise value, Apple is the biggest, as you can see here. Highest in revenue, 391 compared to the 300 of Google, 340 of Google, 250 of Microsoft, and 150 billion of Facebook. Lowest growth rate, 8.9%. Now these companies are still growing massively, 17%, 14%, 19%, which is probably why we've seen the price of Apple kind of stagnate over the last year or two. EBITDA highest as well, and profit-wise, interestingly, despite its high revenue, not the most profitable. If we look at the profit margins here, is last 24% compared to the 28 of Google, 37 of Microsoft, and 36 of Meta. Price to sales, middle of the pack here, 8.6, and I believe the price to sales currently average is around about 3.12. Price to book massively high here, 60 compared to these. The market average is currently 5.2. PEG, we want to see one is overvalued, under one is undervalued, and Alphabet and Meta, well, Alphabet close to 1, Meta under 1. Apple is actually the highest here with 2.32. Now we have EV to revenue, EV to EBITDA, and PE and forward PE. We take some averages, we work them out, and this gives us a implied value per share of $200 a share, interestingly enough. Reason for this, highest forward PE, that brings that down. Highest actual PE, EV to EBITDA, highest, EV to revenue, second lowest. That's why this one is in green. So what I do want to compare is, if we just look at the top 3 companies, we'll go with Nvidia. Does this change the price? As you can see, it loads the data live. If you include Nvidia, it is a buy. If you compare just against these, the sort of magnificent 7, but obviously there's only 4 here. So probably about fairly valued, but if you compare it to sort of what Nvidia is doing, obviously Nvidia has very different numbers here. High revenue growth rate of 40%, 50% profit margins, 55%. But if you included sort of those ratios, when comparing Apple, you can see it's $300, but I think the Meta comparison is a little bit more realistic. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and check my Patreon as well. And I'll catch you guys next time.